Hey everyone, let's stick with us versus herd. If it's your first time here, you like the content, hit subscribe. If you want to join the UVH fam, links are below for our free options trading group, along with the Discord. Let's get into it. We're going to talk about whether or not the markets are going to crash or drop. I'm thinking more like drop, but there's a lot going on in the markets. We're going to be talking about Trump, China, the yuan, currency, bond yields. I mean, we're gonna go through it, and obviously this is my opinion. I'm just gonna go through kind of the way that I'm thinking about the market right now. I know I took a week off. I was down in Florida, little vacation, just kind of hanging out with the fam, but we're back at it, and I've just been taking it all in, looking at what happened last week, looking at what's going on with the markets and what's going on here. First I'm just looking at the chart. We have SPX up here, and as you can see here, we did drop considerably from the high of 3,027.98 and we dropped down to 28. The low was what, 28.20. So we dropped within 1, 2, 3, 4. Within 4 days we dropped almost 200 points on the S&P, which is quite a bit. And what I'm looking at here is the 1-year chart, and as you know, going into right now we're almost halfway through August. September historically is the worst month of the year for stocks. It's just, look it up. It is what it is. I'm not saying it's gonna be bad. Last September actually wasn't terrible. If you remember here, last September, here we were in August. Last September we kind of just were treading water. Not a whole lot going on, just kind of moving up a little bit slowly. We had some down moves and then we had some up moves, and but then that's when the wheels fell off. Almost to, we're almost getting to the point where at the end of September, early October is when the stock market started to fall. And I would say it wasn't a crash. I mean, this was nothing. This was the most volatility we've seen in a long time. But now we're seeing more of this more frequently. VIX is above 20 again, and and you can see that the chart shows why it's above 20 and why it was peaking here. And if we're looking at this area of the 28, like the 2880s area, is where like right in here is where things get a little dicey back down in here. So and the way that I see it is that there's a lot stacking up here. We're also going into an election year, and if you guys don't remember, going back to, some people might not have been trading the last election, but let me pull this up for you. The last election year, we'll go into. Okay, so this was the. Let me make myself a little bit smaller here so you can see. The last. With all this stuff going on, and we had the elections. This was 2016 going into 2017. Let's go into. Okay, let's get this up right here. No, that was right. Yeah, so 2016 going into 2017. As you can see, we had, for the time it was pretty volatile. I mean, we were still in an amazing bull run, and the markets sold off in the beginning, like at the end in December here, going into 2016, and then it was very tough to trade if you're swing trading, and I was. I still am. I still love to swing trade, but when the news, the stock market was very news induced. It was selling off based on, if Hillary wins, the market will go up. If Donald goes up in the polls, the market will go down. Obviously how this all ends, but just to be aware, we are going into an election year. People may be taking money off the table to reduce risk. along with all that's going on. And when people are uncertain, when people are not sure what's going to happen in the future, then they start taking money off the table, because right now, if you're thinking about it, right now a lot of people are sitting on some fat gains. I mean, huge gains. I mean, some people might be up 7 figures, 6 figures. A lot of money, especially people that are looking to retire within the next couple of years, maybe this year, maybe the next couple of years. They're going to be looking to reduce risk. A lot of baby boomers are getting old. They're retiring. They're looking to reduce risk. At this point in their lives, I mean, they were just part of an epic bull run. I mean, we're still in it. Don't get me wrong. We're still in this epic bull run, but you just got to be concerned about, all the mixed signals that we're getting. Yes, it's news induced. Yes, we're doing a lot of it to ourselves, but then also, you can't get too confused with the media. The media also has been hyping it up. When we crashed down here, or dropped from down in the 2,700, and we were moving back up to 3,000. I mean, everyone from CNBC to all the news articles, everyone was saying, "Hey, now's a great time to buy stocks. Now's a great time to buy stocks. Hey, we just crossed over 3,000 again. For the first time. Now's a great time to buy stocks." And then a week later, we're down, and everyone's saying, "Oh no, the inverted bond yield, the inverted yields, and all this stuff happening." And then, one of the biggest threats was, this is not to be political or what's going on here, is that, what caused this initial drop was the tariffs that Trump decided to put on. And let me pull this over here for a second here to get you looking at what I'm looking at here. President Donald Trump's trade war with China was increasing the odds that America will be thrown into recession, according to investment bank Goldman Sachs. Now, I kind of just look at everything. You don't want to take everything that Goldman Sachs or Bank of America, or any of these big firms, because they have their own agenda to back this up. So they have a reason to be public about this information. But at the same time, the Goldman Sachs did reduce the outlook for Q4 for the U.S. And also on September 1st, Trump plans to offer a 10% tariff on $300 billion of Chinese imports. So he announced that, and that's going to be effective September 1st. And it's kind of interesting, because it says here, on Friday, the president told reporters, "I'm not ready to make a deal with China," asserting he's saying it's working out very well. So he's saying that, hey, all these tariffs, we're getting billions of dollars going right into the Federal Reserve. We're getting fat. We're getting money. We're doing all this stuff. A lot of people disagree that that's working. My stance was that he initially tried to bully China in the very beginning, because most of the time, if you look at his track record, when he bullies somebody, they back down. They may swing once or twice, but eventually they back down. But China has not backed down. China has only fought this. They've basically gone to war with Trump here. They're saying, they're not going to lose this. They're not going to back down. Yes, the U.S. is a bigger threat, but I mean, China is the second biggest economy. They're the number one in the world for exports. I mean, they're not a small country. You got to think about that. He's messing with the number 2 spot right now. It's not like he's messing with somebody that's 10 on the list or even 5th on the list. I mean, this guy, China's number 2. So, he thought that he was going to be able to bully his way into that situation. I think I personally think that he underestimated China, and that how resilient they are going to be with this trade stuff. So I think that's going to have a big impact. And they're saying that they're very skeptical that the two sides are going to have a deal before the 2020 election, which, I mean, this is just going to add more fuel to the fire, and especially when the campaigns and the rallies and all that stuff really start to take place. All this stuff, it's going to be very interesting to trade this. I mean, it's going to create great opportunities for options trading. I think this is a great time for people to trade options. You're going to be able to make a lot of money. You're going to be able to learn a lot. I mean, this is a great time to trade. But at the same time, you've got to be very, very, very careful, because you can easily, as fast as you can make money, you can easily lose money as well. They're worried that the trade war is going to trigger, a recession, which kind of gets into the next point, which is the yield curve here. Stocks and bonds. If you're not sure, well, I'll read this first and I'll go into it. It says a key barometer of the risk of future recessions is sounding its loudest warning since April 2007, months before the start of the last financial crisis. Shorter-term bond yields have climbed above longer-term ones, a phenomenon known as an inverted yield curve. That tends to happen ahead of recessions, yet economic growth remains steady and the labor market strong, stoking debate among investors about what the signal means now. So, I mean, the economy is doing well, things are doing well, companies are doing well, and that's why we're getting a lot of mixed messages, like, CNBC, Yahoo Finance, Google, all those people, all those places, they're reporting on things, and nobody knows what is going on, and that's okay. I mean, no one knows if the stock's going to go up tomorrow or down tomorrow, and that's the way it's been. That's the way it will always be. No one, if everybody could predict the future, everybody would be rich. Everybody would have millions of dollars, billions of dollars, trillions of dollars, and I definitely wouldn't be here debating it and talking with you about it and what I feel and what I think about it. And if you're not sure what bonds have to do with stocks and all that, basically bonds compete with the stock market in terms of liquidity and money going into stocks versus money going into bonds. So when the bonds are a much safer play, which with a much lower return. But when people view stocks as getting risky, they start putting it into bonds. And that means they take money out of stocks and they put money into bonds. And it says shorter term bond yields have climbed above longer term ones. So that means, the shorter term bond yields are climbing, which means the rate of return is getting higher, which making it more attractive for people to reduce risk, take it out of the stock market and put it into bonds. Going down into here, they kind of show you, some of the historical data here on some of the last of initial yield curve inversion. In 1973, then after following the yield curve, it went down. The S&P went down 16%. 1978 was up 5.9%. 89 was up 12%. But then in 2000, down 16%. You can look this up. The link's right here. You can look this up and check it out for yourself. But that's kind of what that means. So it's an indicator. Bonds getting more attractive. Maybe people taking money out of the stock market. They're not. At the end of the day, no one knows what's going on. You kind of have to always go with your gut on what you feel. I mean, take the data. Like I'm giving all. I take all this data in. I look at it and I just trade accordingly. I trade. Being an options trader, we're mostly pretty short term, so we take this data in, and it's not that I'm planning for the next crash, but you have to be mindful that the stock market could be in big trouble here with these things going on. The facts are definitely stacking higher with the bearish sentiment than they are with the bullish sentiment, and that's kind of how you have to balance the market. And then what was it? In response to the tariffs, China devalued its currency to make exports more attractive and to kind of balance out the tariffs. And then the U.S. accused China of currency manipulation, and all that is not good for the market. Whether I mean, definitely something is going on underneath there. I mean, there's a lot of things also in the market as retail traders we don't understand. And then going into earnings. We're starting to wrap up earnings. So earnings we have this week, we have some of the bigger companies. We have Alibaba, Walmart, Nvidia, Cisco, Macy's, JCPenney. So it's kind of wrapping up. We got mostly retail, not a whole lot going on, in terms of bigger companies. So we're just trying to wrap it up. But for the market, I mean, I would definitely trade very cautious. Align your profile, your portfolio the way that you want to do it, the way that you feel. Like they say, like when people, like they say, if you love the S&P at 3,000, you're gonna love it at 2880. But that's just the way I see it. I think that the equity markets are going to be. I mean, I've been saying this for a while that it's been risky. Also, going into the election, going into the unknown, people don't like that. And then we have this trade war, and now a potential currency war that we're going to war with China in. So it's there's a lot going on here. I mean, things could turn around. I mean, we could strike a deal, but it looks like Trump is now saying he's not looking. He honestly may have sabotaged the deal on purpose. There's a lot of things that we don't know, so we just have to trade safe, trade accordingly. If this video was of value to you, I'd appreciate it if you hit the like button. Really appreciate it. Thank you guys for watching. Stay safe, stay green. It's always us versus herd.